to invite on stage Eva Lorenz from Figment, Peter Hubli from the Zürcher Kantonalbank, Fritz Joost from Signum Bank, last but definitely not least, Ricardo Donega from Banca Sella. Please join me on stage. Whoa. Here we go, and the seating is as per on screen. Yeah, exactly. I think even.
You want me to move up? Yeah, sure.
Yeah, just in order to. It's fine.
Right. Nice show of your athletic ability there, jumping on the stage. I appreciated that. Hello, everyone. It's a pleasure to be here in Zurich today, and I'm very excited for this panel and to be joined by these esteemed guests. I have been told that Peter and Fritz have a reputation, perhaps, of speaking together on panels, so I'm not even sure if I'm needed today. I think they could probably just carry on without me, but hopefully we'll add some value. So today we're going to talk about the bank's digital money dilemmas, tokenized deposits, stablecoins, and more. So without further ado, I would like to introduce each of our panelists. Peter from ZKB, Zurich Kantonalbank, the head of digital asset solutions there. ZKB is a 150-year-old institution with a state guarantee and some might say conservative reputation. So Peter, my first question to you is, what is the case internally for entering the digital asset business, and what has the journey actually looked like from your first B2C, B2B crypto offerings through to settling digital bonds against wholesale CBDCs?
Yes, good morning to everybody. Thank you for having me here, Eva. Indeed, ZKB is quite old, traditional, and very conservative. But on the other hand, we are AAA rated, and we are the second safest bank in the world. Before you ask, Eva, the safest bank in the world is a smaller bank in Germany. I don't know why everybody always asks about it. Nobody cares about this small German bank. We are the second safest bank in the world. That's the message. But I need to work on my sales pitch, I guess.
I think so, maybe.
But yeah, going back to a point, our journey into digital assets has not been a walk in the park, but we have to differentiate. ZKB believes in the new technology and see the potential. For example, as you mentioned, we issued the first digital bond and settled against wholesale CBDC as part of the project Helvetia Phase 3. We see huge potential in the fund industry because the settlement processes there are still like in the 80s or 90s. Our concerns are more against crypto. Main reason is reputation risks.
Right.
Nevertheless, we have been offering crypto services to our B2C and B2B clients for more than 1.5 years. Motivation was the demand from our customer, especially from the B2B side. So we were approached by several banks which asked us for providing them with an infrastructure because they have also a strong demand from their clients. That's the reason why we offer crypto trading and custody for our clients, and that's for now more than 1.5 years.
So would you say you've seen that tipping point in terms of crypto and crypto adoption, or do you think we're still on the cusp?
We see it is extremely market-driven, you know. If we have a Bitcoin price over 100K, then I get a lot of phone calls from other banks as well,
right,
because they say, now we want to offer it, let's talk. And 4 weeks later, they say, if I call them back and says, let us talk now, they say, and the Bitcoin is going down to 80,000. So they say now it's going lower on our privatization. So that's a little bit the point. It's really driven by the market and less by inner motivation.
And let's jump over to Fritz. So Fritz Joss from Sygnum Bank, thank you for joining us. Fritz is the Chief B2B Officer at Sygnum. Fritz, Sygnum describes itself as more of a tech company with a banking license than a traditional bank. And in 6 years, it has grown from 0 clients to 5.5 billion in assets under custody, serving over 25 different clients. You've argued that crypto, not tokenized deposits, is the first big wave for banks entering digital assets. Can you share a little bit more on why this is the case?
Yes, thank you very much. Also, thank you for having me. Number one, banks move when they get disrupted. So they realize that, number one, that maybe there's a risk of the fiat world moving onto the blockchain. They also see money moving out across the street to providers who actually do service clients who want to invest in crypto. And probably thirdly, they also see that it's very difficult to connect to the next gen. Next gen, sure that my colleague is going to highlight how they have really been activating their next gen. We see it also from our banks. They are completely oblivious when you talk about US treasuries or even equity, but they are very connected when you talk about crypto. So we've seen that from these next generations, more than ZKB, you mentioned 40%. We see sometimes banks up to 60% of investors in crypto are, for these banks, first-time investors in investment products. So banks realize that for these reasons, they need to be future-ready. Future-ready, all these use cases have one common infrastructure, and therefore we see them looking at the roadmap, not only the first destination of going buy, hold, and sell crypto, but really map out the entire journey. And we can really see, at least from our side of the market, that the train has left the station. Discussion is not so much about the why anymore, it's much more about why not.
So the banks are focused on future-proofing their roadmap and their product roadmap?
Absolutely, and I could take maybe examples of commercial banks, also PostFinance. They have PostFinance, they have more than 1 billion payment transactions a year. They looked at this a couple of years ago and said, look, if fiat is moving onto the blockchain, we will be completely disrupted. And so see it other banks as well. So the time is of essence, and therefore we're going to talk about this probably later, buy versus sell. It is important that you're future ready and you can actually engage in those use cases.
Thank you, Fritz. And now to our third panelist, Ricardo Donega from Banca Sella. Ricardo heads up DLT and digital asset products at the bank. Ricardo, Banca Sella decided to enter the stablecoin space, not by issuing a stablecoin directly, but through a consortium. Walk through that decision. How did the bank get to that approach? And was there a particular regulatory path that led you there? And what does it tell other banks who are maybe contemplating the same issue? What should they learn from your strategy?
Sure. Good morning to everyone, and thank you for listening to me. So there is a funny story about that. We first start by trying to issue our stablecoin. So we started working like 4 years ago, where we founded the DLT Competence Center. We done a first project together with the Italian regulator under the new MiCA framework to issue a stablecoin in a so-called test environment. We done all the path to train internally our people, to build the team, to build the technology. We end up issuing a test stablecoin on Algorand. Then we get the approval from the Italian regulator, meaning that they see the project, they made some question. We try also to educate each other around the new MiCA framework. Then we end up asking ourselves, what could be the business on that? And we quickly realized that for a bank, especially a bank like Banca Sella, which have a huge, I would say, share in payment market in Italy, but still a regional coverage, really doesn't make sense to issue a stablecoin by our own. And so we done all the discussion with the consortium. We end up joining Kivalis. And we believe that the main point on issuing stablecoin, especially a new one, is the distribution channel, as you might imagine. We will face competition from USD native stablecoin, which huge market share. So having a strong distribution channel is one of the key to grow a stablecoin. Together with the consortium in Kivalis, we are building this distribution network, meaning that a lot of banks are joining us, and I believe this is the key challenge for our project. If I have to talk to a new bank that want to issue a stablecoin, I would advise, of course, to focusing on what could be distribution channel, the business model around that, which use case. I'm strongly convinced that banks have a big opportunity still in the stablecoin market, because we could bring to the market new clients that don't really know what crypto are. I'm talking especially about Southern Europe and Italy. And for this reason, if you find a good leverage between having a good use case, strong distribution channel, maybe a stablecoin in euro, which is something new in the market that we already have, we don't have offered by a bank, I believe there is a good opportunity to build a new competitor to USD stablecoin.
Thank you. Now, Fritz, you touched on it already. Partnership in this industry is so important, especially for the banks. It's something we're focused very much on at Figment. How can we meet the needs of our large institutional banking partners? When a bank or institution, like each of your respective firms, decides it wants to offer digital asset products, the first question is generally whether to build infrastructure in-house or partner or go out and buy. Whether it be through an acquisition or a partnership with another firm. Given the technical complexity of custody, compliance, settlement, how should each European bank think about that choice? Where have you seen it go right and where have you seen it go wrong? Do you want to kick us off on that one, Fritz?
Yeah, I think that from the more than 25 banks which have partnered with Signum, only one decided to build. And actually took them several years to market. And what our strong recommendation really is, map out the journey, because the journey is the destination. Don't just look at the first mile or milestone, which may be buy, hold, and sell crypto. Look at what is the business case, go to staking, transfer ins, transfer outs, look at maybe the lending side. So once you have mapped out, you know what infrastructure you need and also what partner you may need to actually be the partner of choice on the journey. And the time to market, as we have mentioned before, it is essential because as we see the outflow of many banks and they say, look, we need to stop it, and therefore build is the right decision, at least at the beginning, because you can actually be live, up and running in less than 60 days, depending on complexity. And that means that you can send out a lighthouse signal to your clients. We open for business and actually really engage in those use cases and be ready in case, be it the fiat, which goes more and more onto the blockchain, that you are future ready. But also, it doesn't mean that you are bound to actually continue on that journey, because the modular offering allows our partners at least to insource when they have validated the use case and when they maybe see the necessity to insource certain services. For example, global banks with an investment banking division, they want to insource at the later stage trading. So they will insource this. The same may be for the custody solution, or they may want to build a second custody solution just as a fallback, because if payments are going onto the blockchain, then maybe they definitely need more than one custody solution, and then they can insource it. So in summary, it really is the journey, is the destination, buy to start, but it doesn't exclude to build at a later stage.
May I add something?
Please do.
No, I fully agree with Fritz. I think for small and mid banks, at the moment, it doesn't make sense to spend a lot of money to build up their own infrastructure, as long as they have partners like Signum and ZKB, which support them and make their onboarding much easier. At the moment, what I see is that many banks are discussing the next strategy period, so till 2030, and they ask me, they want to add cryptos into their strategy. And I always say, and don't be so focused on cryptos, because what Signum and ZKB are offering is the access to public blockchains. I think if you think about the next 5 years, what you need as a bank is access to public blockchains, because that's much more than cryptos. And that's exactly what I think what should be in the strategy for more or less all banks over the next 5 years.
Okay, great. I'm glad he didn't just say private blockchains there, though. That's good. Ricardo.
Yeah, one more thing around that. I believe that as a bank, the first choice you need to take when you enter this world is either on doing custody on your own or to leverage on an external provider. I believe that decision is crucial also in terms of business. It depends about your business and what kind of market you want to take, because doing the custody inside the bank could offer also value added to the client, meaning that as a bank you can provide much more security than an external provider. But on the other side, it's something that to be really a value for the client need to be done really, really good, because offering custody is a different job than what we are used to do with classic money and bank money. It requires all the new technology stack. So you need to be sure that you want to do that path to offer a really strong custody. Otherwise, it's probably better to go with the external provider. I believe that they can speed up the market, the go-to-market strategy. But on the other side, I would also consider to retain some part of the secret or the key inside the bank to give more assurance to our client. I see, especially in Italy or in Europe, a lot of banks doing let's see, trading or payment service, just going with external provider, which is something good. It could help to speed up the market value. But as a bank, I would consider also the value of offering custody to our client, because security, it has been proved in the last 3 years, is one of the core topics around this world, and is the basic infrastructure to build everything on top of that.
So speed to market is key, but balancing it against security and compliance. Fritz, you look like you wanted to add something there. Did you have something?
It's maybe just to share one other thought is going back to the notion of the journey as a destination. Do not underestimate the logistics which this takes, particularly in amending your org reg, because most banks, at least in Switzerland, looking at the existing org reg, they can actually just inform FINMA, but the moment they go into staking, transfers, and the likes, they have to change the org reg, they have to go to FINMA, and that can take a very long time. We have partner banks who have been waiting for more than half a year and still working on the application. So time is of the essence, and if you can plan this, do it, because every one of our banks is not just, even though they may be live with buy, hold, and sell, all of them are working on releasing new services. But as said, it takes a lot of administrative effort and the attention of FINMA to give this priority.
Yeah, that's a good point. That's a good point. There's a common assumption that tokenized deposits are the natural, safer entry point for banks, more familiar, more regulated, less controversial than crypto. But the volume and adoption of data suggests otherwise. I would like to ask you all, do you consider crypto to be the first wave, or tokenized deposits? Where do tokenized deposits and stablecoins actually fit into the digital asset journey once a bank begins to move forward?
I think it's quite difficult to bring all these topics together, because the purpose for cryptos from our customers is a totally different one. What they are doing is they buy Bitcoin, they want to impress their friends that they have Bitcoin, and then they wait till the Bitcoin is 1 million and they want to sell it. That's their strategy. So cryptos is really, from my point of view, just for investments as a new additional asset class. And tokenized deposits and stablecoin now is a totally different story. And in Switzerland, we are really early at the beginning in this story. We not yet have a regulatory framework for stablecoins that's on the way. And what we see in our bank is that at this early stage, we do not have any demand from our customer, neither for tokenized deposits nor for stablecoins. What we are doing is we prepare ourselves because we can imagine that at some point in the future that will be a demand for the well-known use cases like cross-border payments, settlements on-chain, and so on. But at the moment, I think in Switzerland, we are really on a very early stage.
What about you, Fritz? Where are you seeing any demand for stablecoins and tokenized deposits, or what comes first in the customer journey when banks are reaching out to Signum?
Well, I would not say it's a Shakespearean question to be or not to be in tokenization, but it's more, how do I allocate scarce resources? At Signum, I mentioned it before, we're a tech company with a banking license. We started more than 6 years ago on tokenization. Big dreams, big hopes, obviously too early, as we know now. We've been tokenizing non-bankable assets to make them bankable, be it art, collectible, wine, real estate, and we even we created the digital Swiss franc to really be living up to the spirit of this to be atomically settling on the blockchain. So we've had that for more than 6 years, and it's not that we are not active. We've done a lot, but it's certainly not to say that it justifies the existence of Signum financially. At the moment, we're certainly very busy in the areas of tokenizing VCs because lifecycle management is much more efficient on the blockchain. And we heard it also before, money market deposits, tokenized money market deposits. We certainly see a big trend, but it's still very fragmented. So don't make a business out of it unless you have a long breath. But yes, absolutely, if you have scarce resources, make the allocation, but do not ignore tokenization.
And what about from your perspective, Ricardo? I think you service a slightly different sector of the market. Does it offer a different view on where stablecoins and tokenized deposits appear in their journey?
So regarding the tokenized deposit, I agree with the fellow panelist. Is not the kind of product that our clients are asking for. Also because I believe that tokenized depositor could be seen like an instrument to streamline payment use case that are already live. So I believe that tokenized deposit could be used for between banks to streamline, for example, international payment, delivery versus payment use case. But on the other hand, we are not seeing a growing development of this use case, this kind of product, because it's still a bank product that need to circulate in closed loop between banks, and this make more difficult to create the right channel, the right framework to create deposit token that can circulate. And also another topic is that this kind of instrument are still depending on central bank money settlement. So you can use, for example, deposit token to pay cross-border between two banks, but still you will then need the central money bank to settle, to reach the finality of payment, and then you end up using probably, again, a legacy system or connections to Fedwire or Target2. So there is a potentiality for deposit token, but probably still too early to find the right framework. While on stablecoin, in my opinion, is a different story. It's a product that is already live since a lot of years. We do have clients that are asking us to provide on-ramp and off-ramp to use stablecoin for payment. We are seeing small, medium enterprise and even retail clients using stablecoin for doing remittance or international payments. So I believe the market is more mature to start offering something, and that's why we joined Kivalis, of course. And in general, I see a future where these two kind of instruments can live together with different use case probably, especially again when it comes to doing international payment or cash leg to tokenization, money market fund, Web3 application.
Thank you. Now, let's talk about wholesale CBDCs for a moment. ZKB settled transactions against the Swiss National Bank's wholesale CBDC through the Helvetica 3 project, I believe. I'd like to ask you all what you believe the central bank's role is in wholesale CBDCs. The central bank money in a tokenized financial system, what should we expect there? Is CBDCs a complement to tokenized commercial bank money, or is this a competitive relationship further down the line?
Finally, complementary and not competitive. What we have seen at the Helvetia project phase 3, first of all, that it worked quite well. So neither technically nor operational any challenges. So it's quite easy to implement. What we have also seen is the huge media attention at the time. It was enormous. It was really a big success in case of marketing. I would say for daily business, it doesn't cover this problem of the missing cash leg on the blockchain. It is complementary, and I think it could be help, and we see that, I guess, in Project Agora, that it could work quite well together with tokenized deposits, for example, but it will not cover, especially not in Switzerland, as we only talk about the wholesale CBDC, so it will not cover all of the challenges where we have with the cash leg on-chain. I think we are now in project Helvetia Pilot. That's the following project after phase 3. And what we see now is that we are struggling a little bit with the use cases. So what we are looking for is new use cases for the usage of this wholesale CBDC. Wholesale CBDC is a good thing, but what we have to look for is where is the perfect fit into the industry, in this digital industry, where we can use the wholesale CBDC on its best way.
Maybe just to add on this, yes, it does make headlines, but it doesn't pay the bills. But I really feel that we need, as ecosystem players, to innovate and to be future ready. Even though it's not here yet, but we need to be ready when it comes. With Signal, we have also done, together with UBS, Postfinance, and the Banker Association, a pilot on deposits, tokenized deposits, because for us it was important to be at least future ready on two things. Number one, to be clear on being able to do the interbank transfers of deposit tokens. And number two, the technical aspect is normally the easier one, but also the legal framework to establish that it's actually done. So that does mean that we need to tool around to be ready when and if the demand comes, and not then try to catch up.
Yeah, last quick remark on that. In Europe, probably digital euro, both wholesale and retail, will be one of the major main of payment. I'm pretty sure about that. But we need to consider that at this moment, people are already changing the way they're using money, and this will continue in the future. We already have clients using, for example, stablecoin or crypto, and they are also trying to and starting to interact with DeFi, and I believe this part of the economy will grow in the next year, and I believe that we need to give also an answer to our clients that are interacting with this protocol, that are using this use case, that are sending money, for example, international with stablecoin. And as a bank, we should be ready also to offer that kind of service together with CBDC and maybe deposit token to be one-stop shop for all the payments need for our client.
Thank you. Now, we don't have long left, but I'd like to take a couple of minutes to talk to you all about the future. If digital bank money, whether that's stablecoins, tokenized deposits, wholesale CBDC, continues to evolve over the next 3 to 5 years, where do we end up? And what is the next step on that journey that genuinely excites each of you, whether it's tokenized money market funds, programmable payments, or something else entirely? Who would like to go first?
So I can go first if you want. So,
Go ahead.
so we talk about future up until now, so I can talk about sci-fi, so real far future. I believe that one of the most interesting topic is agentic payment on blockchain. I believe that blockchain could be a common layer for all the company, all the banks that want to interact with agentic payment. I cannot imagine having this agent interact with the normal core system. It will be probably too much segregated and not transparent enough. And I believe in the next 10 years, probably we will see a lot of these transactions, especially machine-to-machine transaction going on blockchain with the stablecoin.
Who wants to go next?
I would say just to tokenize a traditional asset is not effective. What we need tokenized money that we can use the benefits from the blockchain, from the programmability of the assets and tokenized money. That makes sense for me. What we need is we need use cases to prove that. The problem is a little bit to establish these use cases, keyword mass adoption, we need the banks. And if you want to have the banks on board, it must be able to monetize these use cases because the time of POC is over. Really, all these use cases have to be monetized. And I think that's a little bit the challenge where we have right now, and hopefully we find a way how to monetize these various use cases where we talk about. By the way, same challenges with AI at the moment as well. Sounds great, but then to shift into that you get a benefit from it, financial benefit as bank is quite difficult. And I think we are at the same point. And I'm a little bit scared that really we should push forward that as soon as possible we see these benefits also in a financial way for banks. Then you get the banks on board, not only for cryptos but also for tokenized assets. And then with this mass adoption, we will push the industry forward. And that's my hope, that we'll find these use cases which can be monetized.
Thank you.
I just love the disruptive nature of blockchain. And either banks are going to have a seat at the table or they're going to be on the menu. And really the blockchain in terms of addressing those single point of failures. It's not just in financial industry, it's the settlement process, the exchanges, all of this is also the authority to take it back to the individuum versus depending on those single point of deliveries. Particularly my background is OTC derivatives, and we know that the settlement of derivatives is hugely complex, and we had many crises because of that single point of failure. If it's on the blockchain, if it goes on a blockchain, we'll have a much better sleep.
Thank you. We've covered a lot today in a short amount of time. We've talked about future-proofing your product roadmap. We've talked about buy versus build, crypto first, then tokenization, everything in between. I don't know, for any of you at the back, you might not be able to see Peter's stocks, which actually say all is pretty. Now, the markets in crypto are not that pretty, but I think that we can agree with the three great banks that we have on the stage here today, digital money in whichever form, the future looks bright for that at least. Thank you all so much, and thank you.
Thank you.